So our next and last individual standard is IAS 7, Statement of Cash Flows. Okay. I need
Okay.
to understand just one single concept when we deal with cash flow statement. Okay. And that
Mm-hmm.
single concept is such that whatever comes in the organization, you're going to add it. Clear?
Okay.
And whatever goes out of the organization, you're going to deduct it. Understood?
Understood.
That is one concept that you have to be very, very thorough with. Okay. And that
Mm-hmm.
is the logic behind everything that the cash flow statements deals with. Clear?
Clear.
Okay. So that is to it. Now, the next thing when it comes to cash flow is that it usually uses cash concept. That means you're not allowed to take anything that is non-cash in nature. Understood?
Understood.
The statement mainly deals with cash inflow and cash outflow, whatever comes into the organization and whatever goes into the organization in terms of cash. Clear? And
Clear.
for that purpose, we have divided cash flow into three categories. One is the operating activities, second is the investing activities, third is the financing activities. Clear?
Clear.
Okay. So the first part deals mainly on day to day business. That means day to day operations in the business, hence the name operating activities. Clear?
Clear.
The second mainly deals with buying and selling of non current assets, hence the name investing activities. Clear?
Clear.
Third, deal with your debt and the capital invested, hence the name financing activities. Clear now?
Mm-hmm.
Okay. So for your FR and SPR purpose, you're going to study only the indirect method. You have studied direct method in your FA. Clear?
Yeah.
So
Clear.
first, we're going to start with cash flows is a mix of these three activities together. Okay,
Mm-hmm.
so we're starting with A, cash flow from operating activities. Clear, no? For this
Clear.
purpose, first, what we need is the profit before tax. Okay, so we are
Mm-hmm.
going to bring
Okay.
in the profit before tax. Now, the problem for profit before tax is that it has every expenses that the business incurs, right? And
Mm-hmm.
that would include the depreciation, which is non-cash in nature, right? And
Yes.
all the other things related with other investing or financing activities, clear, which are not to be
Clear.
taken in operating activities. So first thing that we do is we are going to reverse everything that doesn't belong to, that either doesn't belong to cash flow statement or it doesn't belong to the operating activities. Clear, no?
Clear.
Okay, so what we basically do is we're going to deduct non-operating income, okay, and
Mm-hmm.
non-cash income. Clear, no?
Clear.
Clear? Among
Mm-hmm.
that, first one is the investing income. So whatever is falling on the investments, we're going to reverse it. And the second is finance cost, which is also not an operating activity. Clear, no?
Clear.
The next thing that we reverse is the depreciation or amortization. So, depreciation and amortization is not a cash related transaction, it is just an expense. So, it might have been deducted from the profit. So, what we do is we're going to add it back. Clear?
Clear.
The next is the fair value gain or loss. The reason that we are adjusting here it is it's A, it is not an operating activity. B, it should be in the investing activities, which is together they take it in the proceeds. Clear?
Mm-hmm.
Okay. Next is any provision, that means any doubtful debt, any kind of provision that has been added in the current year should be reversed back because it's a non-cash item. Clear? It's just
Clear.
like depreciation. And
Okay.
any gain on an asset, loss on an asset, any impairment, all of these, impairment is non-cash in nature. These two are not under in operating activity. So we're going to reverse them all and lead to an amount which is before working capital changes. So this is cash flow from operations. Understood?
Understood.
Okay. So to that, we are going to adjust working capital changes. Now, what is a working capital? We have two things under working capital, a current asset and a current liability. Clear? You know
Clear.
the equation of working capital, it is basically CA minus CL, right?
Okay.
Okay, so working capital deals with current asset and current liability except cash and cash equivalents. Understood, no?
Can you please repeat this part?
Working capital includes all the current assets and current liabilities, but we do not take cash and cash equivalents here. That's all.
Okay. Okay,
Okay.
noted. Mm-hmm.
So here what we basically do is we are going to add increase in current asset, decrease in current asset and increase in current liability. I'm repeating again. We're going to add decrease in current asset and increase in current liability. There's a
Mm-hmm.
simple logic behind this. Okay.
Okay.
Suppose your inventory is in 2000, we have 2 years. Suppose we have 2024 and we have got 2023. Clear?
Mm-hmm.
So in 2024, the inventory is 5,000. Okay. And
Huh.
2023 inventory is 10,000. Clear?
Mm-hmm.
Okay. So in 2023, the inventory which was 10,000 became 5,000. So basically, what would have happened? We would have sold the inventories, right?
Yes.
So if we sell the inventories, we get cash inflow. Okay, hence cash
Mm-hmm.
inflow should be added. Okay,
Mm-hmm.
suppose this is not the inventory, this is trade receivables. In that case, also, we are assuming that in 2023 it is 10,000, in 2024 it is 5,000. So there is a decrease, that means trade receivable has paid the cash. Clear? So
Clear.
again, cash inflow. So you're going to add
Mm-hmm.
it. Clear?
Mm-hmm. Clear.
So that is the basic logic. If you're going to add decrease in current asset, you do the opposite to increase in current liability. Clear, no?
Makes sense. Yeah, makes
Okay.
sense.
So for the plus side, it is decrease in current assets and opposite of current liability. Understood?
Understood.
And minus is just the same. Okay.
Mm-hmm.
Because in minus case, you're going to opt the examples of trade payables. Okay.
Mm-hmm.
So suppose the example over here is that of trade payables. So in 2023, you had 10,000. In 2024, it is 5,000. So probably you must have paid cash, right?
Mm-hmm.
So you are getting a cash outflow, hence deduct. Understood?
Understood.
Okay. So if it is deduct, increase in current asset, just the opposite with current liability. That is decrease in current liability. Clear now?
Clear.
Once you do that, you get cash flow from operations after you have adjusted all the working capital changes. Clear now?
Mm-hmm.
Now it doesn't stop here. You have to deduct interest from this. You have to deduct cash from this or add a tax refund. Either tax paid you have to deduct or you have to add back tax refund. Clear?
Clear.
After this particular thing, what you get is net cash flow from operating activities. Clear now?
Clear.
Okay. Now the B part. B part is investing activities which relates to the assets. Okay. So here what we
Mm-hmm.
do is in the balance sheet that is given to us, we are going to straightly move ahead with the non-current asset part. And we're going to see whether there is an increase or decrease in NCAs. Clear, no?
Mm-hmm.
So all the purchases should be deducted because when you are purchasing something, you give away cash. And
Mm-hmm.
all the sales should be added because when you sell something, you get cash. Clear?
Yes. Clear.
When you pay lease rentals, you are giving away cash. Leases ROU related. Clear?
Mm-hmm.
You are purchasing intangibles, you are giving away cash. When you receive any income from investment, you're getting cash. So add it. Okay. When you
Okay.
spend development, you are giving away cash, so you deduct it. And after that, you reach net cash flow from investing activities. Clear, no?
Clear.
Now, the C and the last part is financing activities, which deals with share capital and debt. Clear? So
Mm-hmm.
if there is issue of shares, then that means you get cash, you're going to add it. If you borrow new funds, you're going to get cash, you're going to add it. Clear? If you
Clear.
repay any borrowings, you're going to give away cash, so deduct it. Clear? If you're giving
Clear.
away dividends, you're going to give cash, so deduct it. So dividends paid, what is the equation? Opening retained earnings plus profit for the year minus closing retained earnings. This is derived from the equation of closing retained earnings. Usually, closing retained earnings is equal to opening retained earnings plus this year's purchase profit, okay,
Mm-hmm.
minus dividends paid, right? When you rearrange this equation, you get this particular equation. Understood?
Understood.
Okay. Now, sometimes you may have to pay cash to the lease, right? In the lease table, there is a section cash paid, right? So that
Mm-hmm.
cash paid should be shown here also. Understood?
Understood.
And at last, what you get is net cash flow from financing activities. Understood? No? Now,
Understood.
the next step that you do is you take A plus B plus C. Clear? That is operating, financing, and investing. Clear?
Mm-hmm.
And then to it, you're going to add opening cash and cash equivalents, which you get from the SOFP. And later, the net result is going to be your closing cash and cash equivalents in your SOFP. That is how you know whether you have done the cash flow statement right. Understood?
Understood.
Okay. So this one, the standard is done. Now I'm going to give you a shortcut for every cash flow statement. So for every
Mm-hmm.
cash flow statement, you need the tax expenses, right?
Mm-hmm.
Or you need the tax which is actually paid off. Clear?
Clear.
But the problem is, in the question, you would be given an operating opening balance, you would be given a closing balance, you would also be given an SOPL tax expenses, right? But you
Mm-hmm.
don't know how much is actually paid in cash, right? So what we
Okay.
do is we're going to take the statements that is being given to you. We're going to take the opening balance, and opening balance would be split between the deferred tax and current tax. Clear? So you're
Clear.
going to take them both. Okay. And
Mm-hmm.
yes, so PL, there would be tax expenses. You're going to take that as well. It's a tax payable account. So whatever increases goes on the credit side, whatever decreases goes on the debit side. Clear, no?
Clear.
Okay. Now the closing balance comes the opposite of opening balance, that is this side, right? So you
Mm-hmm.
take them two together, which is also available in your statements, okay? And the
Okay.
balancing figure is your tax paid, which is to be taken in the cash flow statement. Clear, no?
Clear.
Okay. Now, non-current assets. So, in terms of non-current assets, the basic logic is whatever increases the non-current assets goes on the debit side, whatever decreases it goes on the credit side. Clear?
Mm-hmm.
Okay. So, opening balance increases and revaluation gain would increase the assets. Lease would increase the assets. Transfer from investment property would increase the assets. Clear?
Clear.
But you really don't know how much you have purchased. Understood? No?
Mm-hmm.
Okay. And depreciation would deduct the assets, hence on the credit side. Am I recording? Oh my God. Yes, I'm recording, thankfully. Okay,
Okay.
just a
It's
moment.
okay.
Okay. Now, on the credit side, depreciation would reduce the assets, impairment would reduce the assets, devaluation loss would reduce the assets. Okay. Sale
Mm-hmm.
sale would keep down the asset. Transfer to IAS 40 would keep down the asset. Any IFRS 5 for which you have taken the asset would bring it down, right? And
Mm-hmm.
closing balance is the opposite of opening balance. So you write it here, right? Now,
Mm-hmm.
the missing figure would be your purchases. So when you tally it down, the balancing figure becomes your purchases for the year, which you should use in the cash flow statement. Clear, no?
Clear.
Now, the lease rentals. Okay. So for the rentals account, you must understand it's a liability. So it would start from the opening balance on the credit side. Now, in the statements given to you, it would be split between current liability and non-current liability. Hence, you have to take it together here. Clear?
Mm-hmm. Okay.
And closing balance goes on the opposite side, right? Any
Clear.
increase in the year would go on the credit side. Clear? Now, what the missing figure is the lease rental that has been paid during the year, right?
Mm-hmm.
So that would be the balancing figure. Understood?
Understood.
So if you study this page, cash flow statement is going to be really easy for you because all the
Okay.
workings are given here. You just
Okay.
have to take it from here. Clear?
Okay. Clear.
Understood, no?
Understood.
I'll stop the recording.